Welcome, I'm JM, a real estate broker, fund manager, and advisor. With 3 decades of experience working with high net worth individuals. Today, we're going to dive deep into a topic that's fundamental to investing, business ownership, and wealth preservation. How to read a company's financial statements. But this isn't going to be a surface level walkthrough. I'm going to give you what I call the Balance Sheet Decoder. A powerful formula and mindset for truly understanding a company's financial health. We are going to do 2 videos about it, that I will divide this in sections. Welcome, I'm JM, a real estate broker, fund manager, and advisor with 3 decades of experience working with high net worth individuals. I've seen countless investors, even sophisticated ones, get tripped up by financial statements. They either skim over them or misinterpret what's on the page. This leads to bad investment decisions, losses, and missed opportunities. But if you learn how to decode these statements, especially the balance sheet, you'll gain an unfair advantage. You'll see through the noise, detect hidden risks, and identify value others overlook. This is not your average accounting 101 talk. We're going to break down the psychology behind why financial statements confuse most people, expose the traps companies and accountants use, and build a framework for advanced analysis. By the end, you'll not only know how to read financial statements, you'll be able to extract actionable insights that can guide your investment decisions for years to come. Let's get started. Section 1. The psychological barriers to reading financial statements. First, let's talk about why so many people hesitate or fail when it comes to financial statements. It's not just about not understanding numbers, it's deeper than that. Financial statements represent the truth about a company's financial health, but truth can be uncomfortable. It exposes weaknesses, mismanagement, and sometimes outright deception. The average person's brain resists confronting that reality. Most investors want simple answers. Is this stock going up or down? Is this a good company? They want to trust the experts or rely on headlines. But financial statements don't lie. They force you to confront the raw data. Assets, liabilities, equity, cash flow, and make your own judgment. The psychological block is this. People fear complexity and ambiguity. They want certainty, but financial statements are complex and often ambiguous. To conquer this, you need a mindset shift. You must embrace the complexity and see financial statements as a story, not just rows of numbers. These numbers tell you about the company's past decisions, current health, and future risks. Once you see the story, the numbers come alive. Section 2. Understanding the 3 pillars. Before we get to the balance sheet decoder, you must understand the 3 primary financial statements and how they relate. They're the pillars of financial transparency. The balance sheet is a snapshot at a point in time. Before we get to the balance sheet decoder, you must understand the 3 primary financial statements and how they relate. It answers the question, what is the company worth at this moment? The income statement shows performance over a period, revenues, expenses, and profit or loss. It answers, did the company make money this quarter or year? The cash flow statement reconciles the 2, showing where cash came from and went to, broken down into operating, investing, and financing activities. Many investors focus only on the income statement or stock price. That's a mistake. The balance sheet holds the clues to long-term health and hidden risks. The cash flow statement reveals whether earnings are backed by real cash. Section 3. The balance sheet decoder. The formula. Now, let me introduce the core of today's lesson. The balance sheet decoder. It's a method to systematically break down the balance sheet and extract the truth. The formula is simple but powerful. Assets equals liabilities plus equity. Sounds basic, right? But here's the key. You must decode each component with skepticism and context. Step 1. Analyze assets. What types, quality, liquidity, and valuation. Step 2. Scrutinize liabilities. Short-term versus long-term. Off-balance sheet items, hidden obligations. Step 3. Evaluate equity. Book value versus market value, retained earnings, and shareholder structure. Let's break these down. Assets. Not all assets are equal. Cash and equivalents are king, liquid and real. Accounts receivable can be tricky. Are customers actually paying? Inventory can hide obsolescence or slow turnover. Fixed assets like property and equipment may be overvalued. If depreciated improperly, and intangible assets like goodwill require extra scrutiny. Sometimes they're just vanity. For example, a company with $500 million in assets might have $100 million in cash, $200 million in receivables, $150 million in inventory, and $50 million in fixed assets. But if receivables are aging and inventory turnover is slow, that $350 million might not be recoverable. Liabilities, this is where many companies hide risks. Short-term liabilities need to be monitored closely. Can the company meet these obligations as they come due? Long-term debt can be dangerous if interest coverage ratios are weak. Watch out for off-balance sheet liabilities, leases, pension obligations, contingent liabilities. These can explode unexpectedly. Equity. Book value is simply assets minus liabilities, but market value can differ wildly. A company might have a book value of $400 million but trade at $1 billion, reflecting growth expectations. Or vice versa, indicating distress. Also, look at retained earnings. Are profits being reinvested wisely or wasted? Who owns the equity matters too. Is it widely held, insider controlled, or dominated by private equity? Section 4. Real-world example. Let's apply this to a real-world example. Consider a hypothetical company, ABC Corp. ABC Corp's balance sheet shows assets of $1 billion, cash $100 million, receivables $300 million, inventory $200 million, PPE $300 million, and goodwill $100 million. Liabilities are $700 million, ST debt $150 million, accounts payable $100 million, long-term debt $400 million, and other liabilities $50 million. Equity is $300 million. At first glance, ABC Corp looks solid. $1 billion in assets, $300 million equity. What the company owns: assets, what it owes, liabilities, and the residual value, equity. This is the key. It answers: did the company make money this quarter or year? The cash flow statement reconciles the two, showing where cash came from and went to. Inventory is 20% of assets. How fast is turnover? Slow inventory ties up capital and risks obsolescence. PPE at $300 million is substantial. Are these assets properly maintained, or is there deferred maintenance? Goodwill at $100 million. Has the company written down impaired goodwill recently? If not, it might be hiding losses. This is why we must decode every line item. On liabilities, short-term debt is $150 million. Can ABC meet this with $100 million cash plus operating cash flow? If not, liquidity risk is high. Long-term debt of $400 million needs to be analyzed against EBITDA and interest coverage ratios. Equity of $300 million is a buffer. Oh, but the leverage ratio is over 2 to 1. Indicating significant leverage. This kind of decoding reveals the underlying strength or weakness. Section 5. Advanced strategies beyond the surface. Once you master the basics, you can apply advanced strategies. Number 1. Quality adjusted assets. Adjust asset values based on realistic market conditions. For example, write down inventory by 10 to 20% if turnover is slow. Number 2. Hidden liabilities. Research footnotes thoroughly. Leases, legal contingencies, and pension obligations can materially impact the balance sheet but may be obscured. Number 3. Off-balance sheet financing. Some companies use special purpose vehicles or operating leases to keep liabilities off the books. Dig into management discussion and notes. Number 4. Capital structure analysis. Understand the hierarchy of claims on assets: senior debt, subordinated debt, preferred stock, common equity. Number 5. Trend analysis. Compare balance sheets over multiple periods to identify patterns. Growing receivables without sales growth, increasing debt, or shrinking equity. Number 6. Ratio analysis. Key ratios include current ratio, quick ratio, debt to equity, return on equity. Number 7. Insider activity. Look at insider buying or selling. Insiders often have the best insights into the company's prospects. Section 6. The contrarian mindset. Most investors trust glossy reports and positive earnings. The contrarian reads between the lines and questions everything. For example, a company reporting record profits but with rising receivables and inventory might be booking revenue prematurely. Or a company with massive goodwill and no recent write-downs might be hiding an acquisition gone bad. I've seen companies with strong income statements but deteriorating balance sheets, quietly heading towards bankruptcy. The Balance Sheet Decoder forces you to be skeptical. Don't take numbers at face value. Ask, what does this asset really represent? Could this liability blow up? How sustainable is equity? Section 7, Psychological Discipline. Reading financial statements is technical, but it requires discipline. It's easy to fall into confirmation bias, seeing what you want to see, or to be swayed by hype and market sentiment. You must cultivate emotional detachment. View the company as a business, not a ticker symbol.